Hey traders, let's take a moment to thank and feature one of our top sponsors, FX2 Funding. If you're looking to get funded, listen up. FX2 is offering traders the chance to trade with up to $200,000 in simulated capital and receive up to 85% of their results. If you're interested in getting started, use the link being dropped in the chat or the link down in the description below. If you pass the evaluation, you'll receive your feedback and gain access to your new account. FX2 allows traders access to a wide range of assets and allows traders to hold their trades over the weekend. FX2 is giving A1 Trading Show fans 15% off the evaluation fee if you use promo code A1Trading15. So if you'd like to learn more, again, use the link being dropped in the chat or the link down in the description below and use code A1Trading15 at checkout for a discount on any of their evaluations. Now back to the show.
All right. Good morning. Good afternoon, everyone. Thanks for coming back for another day in the markets. We are kicking it off here with a bang as you've got some markets on the move. The dollar index did not stop this weekend. It kept going here. We can see that level that we discussed at length last week did end up breaking and continues to push higher. I had a thought about something, and it was, I pointed out that, the dollar index here, if it was able to break through these highs, and we'll get more closely attuned to the dollar in just a second, but I mentioned that if that, gets through those highs decisively, we could be in for an interesting week. And it seems like we've got that so far. Take a look at, what we've got going on here. We've got indices kind of trading sideways. They were up on Friday, but kind of trading sideways to start out the day. We've got 2 minutes till New York Open, by the way, at least the stock market open. Same thing with the Dow. But what kind of gets my interest this morning is that you've got the dollar strengthening here, and it's pushing things like the pound USD lower, the euro dollar lower, and gold really took a little bit of a nosedive here on the market open this week. Thought that was interesting considering that, we had that news that, the U.S. retaliation in the Middle East, I would have expected to cause a little bit more of a spike on some of the commodity side, but we did not really see that. Anyways, that's where we stand here so far. I want to invite you as we start off the show here, make sure to subscribe if you are just tuning in for the first time. Make sure to hit the thumbs up button on the stream, all that good stuff. And away we go. Let's take a look at some markets here. I'm going to switch over to my one chart at a time view so we can have a look at some stuff. I was looking at semiconductors this morning. This is the semiconductor ETF, SMH, as we saw NVIDIA. It's still up in the pre-market, I believe. This stock is just undefeated right now. What a crazy, crazy, crazy move this has been. And this is the, this is what's happening is we're seeing NVIDIA, the dominant chip maker, just kind of take down names and numbers these days. It just keeps, what the issue is for those of you guys who are curious about this stock. They have so much demand. There's such a high demand for chips, NVIDIA chips. There's such a screaming demand for these products, they can't make them fast enough. And as you could probably guess, if a company has so much demand for their products that literally the second they're creating their products, they're selling them at a premium, that's why the company's up so much. It's a remarkably huge story here. The NVIDIA stock chart is just one to look at. Same thing with Meta if you saw it, but we just hit 930. Let's take a quick look, see what's going on the lower time frames. Just real quick on the indices off of the back of this. Usually you do get some volatility in the opening minutes of the New York session. I've got the S&P pulled up here. Again, pre-market was pretty choppy back and forth, but Russell was down pre-market pretty good. Perhaps, I don't know if you guys saw that Jerome Powell actually spoke sort of on Sunday, the 60 Minutes released, which was a interview that they did with Jerome Powell. I actually listened to it last night and just reaffirmed again the same things that Powell basically said in his meeting. He kind of ruled out the idea of a March rate cut, and areas that are more sensitive to rate cuts seem to be taking a little bit of a sell here this morning, specifically like the Russell. Remember, guys, the Russell is smaller companies in the United States. Smaller companies that are more, by the way, dependent on low interest rates. Whereas when you look at something like the NASDAQ or the S&P 500, here's your Apples and your Amazons and your super ultra wealthy, profitable, established companies. they're not so dependent on interest rates. And we've seen that time and time again. The NASDAQ outperformed massively last year. And, the S&P 500, look at this interesting candle here that we're starting out. We will get to other markets, but I do like to just kind of check in on the stock market, especially when the market just gets open. There's usually some volatility spikes that happen. This is a 5-minute chart. So we are seeing some volatility come in. Quick look at gold here on the day. Gold has been pretty much sold off of the opening rip of the market on Sunday night for me. For some of you guys, it's going to be Monday if you're in, the Pacific or Eastern countries, right? So anyways, what we've seen here so far is we've seen gold really selling off. Here's your hourly chart view of gold. And key thing here, for those of you guys watching gold with me, this level of support, which looked really resilient here, seems to have been taken out. And what that tells me is that this slip to the downside that we're seeing makes a lot of sense, that we could actually just see it head down to retest 2008. So what's key here about gold is that interest rates being ruled out from March, what's going to start happening is not only are they ruling out from March, but they're going to start debating May. And while many people think that rate cuts are going to come in May, I don't know if May rate cuts are coming, but I can tell you this. If the market finds out that May rate cuts are not coming, if they get pushed back to June, if they get pushed back to, the meetings that follow, gold could go much lower in the short term. Now, let me be transparently clear here. Longer term, I'm a bull on gold. I would like to own gold. I would like to have it in the portfolio. I'd like to, all that good stuff. However, in the short term, it's the same reason why the Russell's struggling. Gold, areas that are sensitive to rates being cut. If we don't see rate cuts, these two markets probably underperform. They probably have tough times, right? Not to mention silver, which is down almost 2% on the day already, right? So metals are taking a bit of a beating here this morning. It seems like it's settling in that rate cuts are not coming in March, and the gold bulls are taking a little bit of a chill pill right now. So we're seeing gold come down, and this is fundamentally makes a lot of sense. In fact, I think that gold very well needs to retest this 2008 area, right? And if not that, if we do break that zone, next stop would be, for me, 1980, okay? So if we scroll out on this chart, why is 1980 significant? Well, we got to go to the daily chart really quick. 1980 was a huge area. You know what happened right here? The Fed pivoted. They said, we expect rate cuts in 2024. So rate cuts were kind of announced here, right? Rate cuts were announced by the Fed mid-December. It brought with it a massive rally for gold, but also a massive rally for stocks. But now the fun has been taken away as interest rate cuts are coming, but there's a little bit of a clause there. The clause is it's coming, but it could be a while. And so gold hates that, right? That's why gold is not breaking out. If you're wondering, why isn't gold at $2,500 an ounce? It's because the dollar is stubbornly strong right now, right? So, I thought that was interesting, and it's a tale of two markets right now. You've got areas like the Russell and gold and silver, and these things really hurt by the not rate cuts coming. And at the same time, you have markets like the NASDAQ, which just does not quit. It just keeps going higher. Why? Because this area of the market has some of the really big tech names that are not so sensitive to rates. It's very interesting to look through. Here's the dollar index, guys. Take a look at the daily chart. We are breaking, before I could even talk about this level, it's already trying to break through it. And, we've been bullish on the dollar, so this is cool to see. We are seeing a breakout here on this move higher. And let's discuss this a little bit. What's going on with the dollar? Why is this breaking out, and does it have room to continue? Well, let's look at some stuff here. So from a price action standpoint, 4-hour chart, look at this. We broke through clean levels of resistance. Real nice there, right? That now becomes a level of demand. I got to update my charts here a little bit and clean up my zones. So we broke out on the 4-hour chart for the dollar index. And you might say, well, is this due for a pullback? It very well may be. If this level on the daily chart becomes, a more clear level of resistance, like we get a super long wick today, right? If this candle ends up closing like this, then yeah, we probably go back to retest that 4-hour support zone. But look at the way this candle looks like it wants to close. If that candle closes like that, to me, that would signal, okay, now we have a new floor. We have a new support zone to watch out for. And we may not go back to this level anytime soon, right? That 103.7 level that we just talked about over and over and over. And we said, watch for the break, either direction. And we got the direction, and it was sort of what we were leaning towards, which was bullish to the upside. And that was brought on by NFP in combination with FOMC. Both indicated that rate cuts are not coming and the labor market is very, very strong, which contributes to inflationary pressures. Make sense? So that's what happened with the dollar. And that's why the story for me right now with the dollar is still bullish. We are not in this environment that we saw over here, where it was just rate cuts are clearly on the table. There's no question they're coming. And the markets were just ripping off of that as the dollar fell, right? Markets being, the stock market and gold. Kind of a different story right now. I think we see some pressures. And in my personal view, you guys know I love trading the indices, but I need a pullback. I cannot justify chasing this move. I have to wait for a pullback. And last week, it was incredibly painful. I was really frustrated last week, to be so honest with you guys, because when this move started happening, I was like, okay, great. This is my move, right? And we didn't get it. So I was really frustrated last week. And I spoke about that on the channel several times. It doesn't matter how long you do this stuff. There's still frustrations that come with trading inevitably. It's money moving. It's going to be emotional. It's going to be frustrating. Regardless, you can acknowledge that you have emotions trading. The difference is, do you actually make stupid decisions acting on them? And I could say I didn't chase this move, although look at this. Here's a teaser, right? Chasing this move would have been the right call. This market moved higher. But it would have built a bad habit, because you know what happens when you do that too often? You chase this move and then it sells off really hard, and you could have just been patient, right? So I'm going to be patient. I'm not going to chase the S&P. I'm not going to chase the NASDAQ, even though I want to buy these things. I have to wait patiently. There's several things on my wish list right now for purchasing, right? There's some ETFs that I want to buy. I want to trade the NAS and S&P long. I want to trade, there's things that I want to be a part of, but I have to trade the way I trade. I have to be really careful, right? Dear Nick, still talking about gold. For gold to go up, you would need World War III boots on the ground. Yeah, or rate cuts. I think second half of the year, once you start getting the rate cut story, gold can break out. I think, this is my opinion, the economy is strong enough to keep the Fed from rate cutting for a while, but at these rates, for a while, I think some of the lagged effects of keeping interest rate high for long can lead ultimately to the economy starting to cool. And when that economy starts to cool and inflation is at a point where the Fed says rate cuts are here, I think gold then is looking like a great buying opportunity. So I am bullish on gold. And it's not based on geopolitical. This idea, here's what I would say. World War III, in my opinion, does not have to happen for gold to go to the all-time highs. You know what has to happen? They have to keep printing dollars, which they do every single day, and eventually gold will reflect it. It will just take some sort of triggering event for gold to reprice. Gold is one of those things. It's really boring most of the time. People love to trade gold, but it can go sideways for a decade, right? But for gold to go to all-time highs, all they got to do is keep printing dollars, and they do that every single day. It will just take time for it to reflect. So long-term, I am a perma bull on gold. As long as they are printing money like crazy, the Federal Reserve, which they do every single day, right? I will be a gold buyer in the long term. In the short term, I'm bearish on gold. In the short term, interest rate cuts are not clear when they're coming. People thought March. We spoke again and again on this channel. We don't think March, and we were so right about that. Frank and I, we were speaking about that. We don't get it right all the time, and the time before that with the Fed meeting, we were dead wrong in what was said. They actually announced that they pretty much pivoted dovish, and Frank and I were surprised by that. But this time around, we got it really right. We said, this economic data is coming in too strong. The Fed's going to push back on rate cuts in March, and Wall Street and Congress is going to hate it. And they did, right? So they pushed back on it. And again, Congress and Wall Street are going to hate that. So, but the Fed, I think, as much as people like to have their conspiracies about the Fed, kind of just being a puppet for governments and for all that, I don't truly really buy that. I think that, when Trump was in office, right, Jerome Powell pushed back on him. And when Congress is now pushing on Jerome Powell to cut rates, he pushed back on them. So I feel, honestly, I think he's done a great job overall. And I think that we'll get to where they want to get. It's just going to take some time. And Wall Street has, by the recent FOMC event, you saw what happens when they try and bully Jerome Powell. He doesn't take that. He's been pretty clear in his objective, and his Fed has been overall pretty successful, right? All things considered, we went through a global pandemic, massive supply issues, massive inflation, and overall the Fed has been holding it together. Now, of course, that could be the last phase of decently good times, but we'll see. Anyways, the Dow is down here this morning. The NASDAQ has given back some of its gains, and the S&P 500 is just slightly in the red. You take a look at the dollar index, it's breaking through key resistance. Gold finally starting to see some sell-off follow through. I mentioned earlier, I think on the daily chart, we could be headed back down to retest 1980. Again, no straight up plan for rate cuts right now, I think is going to keep gold wobbly at these levels for now. Once you start seeing, okay, rate cuts are way more likely to happen, once you get that solid answer, you'll probably catch me being a gold bull. But for now, economic data is too strong. So I can't justify it, right? I'm trying to stay fundamentally sound with this one. And we're also just in a range-bound market. If you want to trade the range, you want to buy lows, sell rips, buy dips, sell dips, buy dips, sell rips. Maybe that's something you play. But for me, I'd like to wait for that fundamental catalyst to come in, and then I'll look for momentum trades. Quick look at the COT data. We'll go through this in just a second in more detail. Frank's going to be joining me on the call. Maybe we can look at the COT data, see what's going on there, and then we'll talk a little bit about some of these moves that we're seeing in the market. Stay tuned. We'll be going through the COT filings, what smart money did this week, and why it is impactful to all of our trading. We'll take a look at that in just a second, right after this break.
Attention A1 Trading Show fans. If you're interested in getting free access to the Edge Finder or our premium trade alerts, listen up. For a limited time, our show's partnered broker Eightcap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to Eightcap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
Okay, and we're back with Frank. Hey Frank, how's it going, man?
I'm doing good. How are you?
Good. So Frank, just before the break, I was mentioning that we'd take a look at the COT data. Have you looked at it already?
Yeah, it's
What are your thoughts?
It's just same old mixed data. I don't know what to think of it because now they're buying the NASDAQ. Last week it was a big sell, and this time S&P, gold, dollar are all being sold as well. So I don't know how to read this because COT keeps going back and forth. So I think it's just going to be confusing because we have that mix of what the Fed's gonna do, and I think after Powell talking and the rate decision, that is going to be less hopeful than they thought, and the rate cuts are still set to happen this year, just not in March.
Yeah, and what I thought was interesting, Frank, is I've been thinking about this a lot. The S&P 500 versus the NASDAQ, right? The NASDAQ has a lot more companies that are super less, I guess, sensitive to interest rate cuts. In some ways, you could argue, you could push back on that, and you'd say, well, there are a lot of high valued, tech names that would get hurt by a recessionary period. That is true, but I don't think we're at risk for a recession just yet. In the future, at some point, for sure, but for now, the economy seems pretty strong. And you do have the back end of this year expected to see rate cuts. So I think that the NASDAQ is sort of the play right now for a lot of these institutional money because they have a long percentage that's pretty heavy. They added more to that long position. We can see in the net percentage change week over week. So big money seems to like the NASDAQ. And one of the reasons I would argue is that these companies have a lot more cash flow. They have a lot less dependency on debt. They can always just buy back their own shares. They can raise capital in other ways if they needed to. A lot of them have a lot of cash on hand. You compare that to, a bit more of a mixed bag in the S&P 500. You do have, most of these companies are also rock star companies, but you could also compare this to like the Russell, which is a lot of debt dependent companies. And there's a sort of a tale of two markets here, Frank. I think interest rate sensitive versus interest rate agnostic companies are really two different stories right now. I mentioned this earlier on the stream. Here's the Russell, can't seem to really catch a bid. Here's the NASDAQ, just can't seem to dip. I don't know. I thought that was kind of an interesting play here on the interest rate story we're seeing.
Were you saying that or tech stocks are less interest rate sensitive?
Not all tech stocks, but I'm just talking about the big ones, right? When you look at like Meta and Nvidia and Apple, if interest rates go up or down, they don't really care that much. It doesn't impact them directly. Now, if interest rates cause a recession, it obviously would impact them massively because their evaluations are very, very high and their earnings would come down if the whole economy sort of crashed. But again, I think that these companies in the current situation where we have an economy that's overall pretty strong, as long as that holds up, these companies look really, really poised to not be hurt by interest rates staying higher for a little bit longer. So I don't know. I think it's really interesting.
Yeah, I agree. I just can't really tell. In the long term, I have a feeling I know what's going to happen, but right now, this week is going to be probably mixed, and I've been looking at CAD pairs, oil, just because that's something that's been clear. They're buying CAD, they're buying oil, and they have a bank statement this week, I think, on Tuesday.
Canada does? Yeah.
Canada does, and they also have their version of the NFP on Friday. So I think there's trade setups to look forward to on that. And
yeah, it should be interesting to see with the Canadian dollar. It is. I don't know if it's still this case, but I know that a lot of people think they're going to be the first to cut rates. Depending on what we see in the data, that could be a volatile pair to watch. Any of the CAD crosses could be interesting to watch this week. And the oil market last week definitely surprised me. I tried to buy it, didn't work out very well. And oil has come down despite, there was sort of escalation on the front of the Middle East in terms of geopolitics. The U.S. Did some retaliation, I believe, in Syria, and so there was some bombings that occurred, which of course is a dreary subject. But in terms of the oil market, I would have expected that to cause a little bit more of a spike, but not quite seeing that just yet. But perhaps it's still coming. I do think oil is due for a bigger bounce at some point, but it's pulled back a lot further than I thought it would.
Yeah, but I guess just wait for that bottom, wait for some confirmation, because COT is buying it.
That's a good point. We can pull that up again, the visual here. So we can see they added 1.49% net change in their week over week filing. And this puts them at a 70. So of all the contracts, guys, on oil that we have in the Commitment of Traders report, the long percentage versus short percentage is right here, right? So 70.74% of contracts reported are long and just 29.26 are short. And in the latest filing, we can break this down even further. They added 4,400 long contracts and they closed out of 8,200 short contracts. That's pretty aggressive.
One other concerning thing is retail and COT are kind of converging. So retail is getting very
long
much.
As well.
They're longer. They're more long than smart money.
Oh,
So,
wow. I can see that. Yeah. 86% long on the retail positioning side of things. Really interesting.
which
Yeah. I
is
mean,
not a
here's the
great
thing.
sign.
The question is, who's right and who's wrong in this situation? I mean, I guess in this case, it's going to be both. But we know how this story usually ends. If oil does start to rally, Frank, I think it's a good bet that retail traders would start to close out and perhaps even get bearish, while institutional money would probably hold that trend, right? So I thought that was interesting to think about too.
Well, I think you're right. But if you look at the smart money indicator, it shows you that the different ways of sentiment moving. So if you pull up USO,
Mm-hmm.
you'll see this drastic change in retail sentiment, which was
Oh, interesting. Yeah. You could see a huge spike in went from all the way down here to that's a massive jump. So retail really seems to be buying this dip, which I guess to your point, Frank, about waiting for a bottoming point might be wise because that could be something where it's like, okay, well, maybe this, all the retail traders are picking up positions here, perhaps that has a little bit more room to come down. While again, institutional
yeah.
money might be a little bit more patient. Retail traders can't afford that same luxury.
It's just it broke under a really strong trend line too, which is something to look out for.
Yeah, we can pull up your screen. I see you've got it pulled up there.
Yeah, you had yours going down, which is like almost the same thing, but this one connected like
Mhm.
several days of candles being supported, and this today is breaking underneath. So where do you look now? Do you look at 69? Do you look at 67? Where, or do you just wait till you see it reverse?
Yeah, I think honestly, oil is one of those markets where it moves with so much momentum when it starts moving. So I feel like this move, as much as it does seem like a bit overextended to the downside now, you might see this thing, and I drew your trend line in here just because I saw it on yours, makes sense. I would say maybe the 69 to 70 range here could be kind of the next spot, but not necessarily I like your idea. Like you wait for it to actually show signs of bottoming. I don't really even care if I get the bottom because I know that's going to be a really hard timing to catch. I'd rather wait for this thing to show signs of bottoming out, and then I'll look to maybe buy the higher low if it starts to form, something like that. So good points there, Frank. We got Ivan coming in next, so I'll let you go here. Thank you for coming in and weighing in on oil here this morning and the COT reports, and we'll catch up with you pretty soon this week. We got plenty of good shows, so we'll see you soon.
Sounds good. Thanks.
Hey, Frank. Yeah, interesting thoughts on oil, guys. And again, I would have expected a little bit more volatility on this one today due to the kind of escalation in the Middle East. Again, back to the same old story, waiting for a pullback on the indices this week for me. Not quite there. The Chinese stock market was up a little bit here off of the Asian Open last night. Gold, silver still just taking a nosedive here recently, trying to hold support, but breaking lower. Really interesting. By the way, we mentioned all these cool indicators that we've been working on. We've got the smart money indicator, which tracks smart money or the COT data versus retail money. You can actually get this indicator. We have trials available now on the Edge Finder. If you'd like a trial of the Edge Finder, here you go. We're going to drop a link here in the chat. You can fill out this application right here. Click this link. Fill out an application. You can get 30 days of the Edge Finder if you fill out that, and we'll reach out with some more details there for you. So if you want access to this indicator and all of our other powerful indicators we've been building, we've just got more and more coming this year. So stick around. Try out the software if you have not already. It's a great purchase if you are something of a fundamentalist. If you're trying to get more into fundamentals, you got to have the tools to do so. So check us out. We've been working real hard on it, and give us a shot. Take that 30-day trial. Anyways, we're going to bring in Ivan here in just a second. We're going to take another quick break here just to set us up here before we bring him in, and then we'll go from there. So right after this break, we'll be speaking with Ivan on markets for this week.
We have 4 brand new indicators built for TradingView. Introducing the momentum, extension zones, trend projections, and volume spikes indicators. All 4 indicators work on every TradingView chart and time frame. You can easily see shifts in bullish or bearish momentum. Look and see if price is being overbought or oversold, which could cause a quick reversal. Automatically get a trend line that shows the true trend, bullish trend, and bearish trend based on the most recent market data. Get notified instantly of big spikes in volume to help you find breakouts. All 4 are available now at a1trading.com and can get set up in just a few minutes. Go check out our brand new line of TradingView indicators today.
All right, and we are back with Ivan. Hey, Ivan, how's it going?
Good.
It's good to have you back on the show. Chandler, if you don't mind, also, if you guys could drop the link to those indicators that we just mentioned. For anybody who would like to check out our TradingView indicators, Frank has been designing a lot of those. So if you want to check those out, we'll drop the link here in the chat. Ivan, the dollar index kept going over the weekend. It's still exploding higher. Are you surprised at all?
No, like this is not a kindergarten. This is a professional thing. We expect everything right every time. So I was laughing. I thought, ha, you want a bit of a breakout?
Yeah, no, it had a huge breakout last week, and I was actually surprised. I thought we would see a little bit of a pullback here, but we didn't get one at all. We saw a continued push higher here, and this has been, this candle here was formed by NFP, but preceded by also FOMC, right? We had 2 kind of main events last week, which were really important to markets. And I think with all of those fundamental catalysts, people ask, Ivan, I always think this is interesting. People ask all the time, like, how do you tell if a breakout is a false breakout or a real breakout? And my honest opinion, it has nothing to do with the technicals at all. It's all fundamental. A breakout is solidly formed off of the basis of a real good fundamental catalyst. And if you don't understand fundamentals, I think it's a really highly powerful indicator to understand the fundamentals to tell you if a breakout is real or not. Would you agree?
Yeah, also you have to look at the why. Also, why does the market move? That's the core to anything that they're doing. So when you get new piece of information, and it depends what information, but when you have FOMC on Wednesday saying, "Hey, people, we might not hike," and on Friday you get like a hot NFP, like it just confirms themselves that there is no point of shorting the dollar. There's no point in hoping for rate cuts anytime soon. Fed said we're not going to anytime soon. So it's kind of more, I don't know if it's dollar buying per se, but it's definitely sellers taking traders off, which eventually becomes buys. But it's definitely a clear-cut move.
Yeah, it's very interesting to say the least, because as you look at this move and you say, hey, is this going to continue? One thing I would say is that the dollar index, if you look at the daily chart, I was pointing this out earlier, we had this huge movement lower, and this was all the optimism. And during this time, we were really bearish on the dollar, and I flipped at some point. So. What'd you say?
Rightfully so.
Yeah. I mean, it made a lot of sense. We finally were starting to see the cooling labor market overall. Inflation was overall coming down. We had indicators telling us that the Fed's going to switch into a dovish territory. What has changed now is that dovish rate cut expectations have been slightly pushed back. We're seeing some the data coming in just too strong, and I think that what we've done, Ivan, is we have been kind of, in a way, counter trend following. Think about this for a second. When the dollar was up here, the trend was not down. But Ivan, we were talking all about, hey, if you get something game changing, we're going to be kind of early to this new trend. We were. And now we're starting to be early to this new trend in the dollar. Now, I'm not saying we sold the dollar here and we bought the dollar here. We didn't do that. I started buying the dollar over here, not on this candle. I think I started changing my tone like around on this breakout. But my point is, it's almost like you don't have to be the first one to a new trend, but you want to start to catch it when it's forming. And I think that we do have something here, Ivan, where the dollar index could make a push. Look at the S&P, look at the Nasdaq. They pumped up real high on a lot of enthusiasm. If you look at the market right now, it's very, very optimistic. And while I think that optimism is valid overall, you can get overhyped and overextended in this short term. So I guess for me, I think the dollar index could make its way up to like 106 over time here, as long as we continue to see that data coming in hot. And Ivan, you've said it best several times. We try and stay and remain data dependent, just like the Fed does.
Breaking news.
Did we miss it again?
No, I'll give it to you. I thought you were prepared to.
What's the breaking news? Give it
breaking
to us.
news is ISM services are 553.4, way above expectation and above the 50 threshold.
And look at this. Look at this. Oh, Ivan, this is interesting. PMI is coming out hot like that, causing the market to go down. Jobs data being strong caused the market to dip, but then rally. So we're going to see the dip and rally here today. I don't know, but kind of an interesting reaction. We're not seeing, I kind of thought that good news was good news again, but again, good call on that. 53.4 compared to a forecast of 52. Services PMI coming in still very, very strong. And just another piece of evidence, Ivan, that March cuts are probably off of the table.
Like, the more you look at the data, the more it doesn't make sense. And yes, chat, I do read you. And yes, but we're respecting Nick to finish his thought process, and then we can go news, because it doesn't change much. It is PMI. It is data that will present itself in the GDP in the next 2 or 3 months. So chill out. We are professionals here. Dollar still already strong, already going higher. So even if it does make the dollar stronger, it's still not a buying opportunity for both of us at this point.
Sure. No, you spoke correctly. I can't justify buying the dollar after a breakout. However, look at gold getting smacked down by PMI numbers. Remember, if you trade gold, guys, you want to keep an eye, as Ivan just pointed out, PMIs, GDP numbers, the health of the economy is inversely related to gold, because a strong economy means a strong dollar. A strong dollar puts pressure on the metal, makes it less affordable. Price of gold goes down. And PMI numbers, another round of, we saw advanced GDP, retail sales. I mean, you can take your pick. There's been a lot of strong economic data. The bears on the dollar will say, well, manufacturing PMI is still, in the gutter, but services, we're a services country, and it's a big component of our output in the US. So that's another red hot economic number. And Ivan, let me ask you this. Here's another way of asking the question. When do we get dollar bearish again?
Good question. No answer. There's a day I'll find it. Give me like 2.5 seconds and I will respond to you. Now it's probably like 13th of February, I think. The next CPI report. CPI report. So can be in a week's time, but if also that one's too hot, maybe in March.
Yeah.
Overall.
Yeah. No, I think at the end of the day, the cheeky answer that people, are maybe frustrated by hearing, but it is genuinely the truth, is we'll wait for the data to show us. Like, it's so hard for me to say on this dollar move, like, oh yeah, I need to get bearish at this level, right? Think about it. So many traders out there, Ivan. There's no question why retail traders typically fade good moves, is because they don't understand fundamentals at all. Like, this move is happening because the data is strong, and it's pointing to a stronger chance that interest rates remain at these current levels for a longer period of time. Those are straight up real forces in the world strengthening the dollar right now. Until that changes, or we get some different narrative, we get some different data, we remain trend followers on a fundamental level, more so even than a technical, I would say.
But just pull back on DXY a bit more, like bring up November as well.
Yep. Let's go to the daily. There it is.
So the move started 14th of November around 105.5. That's still the target. That's when the market has priced out any rate cuts this year. So of course, the more the data shows that we're not going to cut this year, the more likely 105.50 and as a 105.5 is likely to be hit. So that's obviously the target. But if we are going from rate cutting to not cutting anymore, we're going to go beyond that. But that's at least the rebound. And for people who are a bit blind and thinking, where is this going, what is happening, is when we started the move is kind of where we target to go back to, because we now are basically reversing what we once priced in. And if we are not having any likeliness of rate cutting, it's probably going to go beyond that.
Yep. No, I mean, here's the thing, Ivan. I would love to be, well, here's the thing. A lot of people are very optimistic that rate cuts are coming, but we don't know when rate cuts are coming. As much as people, experts are forecasting that rate cuts are coming in the second half of this year, they could be dead wrong. I mean, I'm not saying, I think that, consensus likely has it right. I do think at some point we will cut rates. There's no question there that at some point in the future, rate cuts will happen. But the question is, what happens if rate cuts don't come until very late 2024 or even 2025? The dollar index is going much higher, right? I mean, Ivan, what happens in your view if we keep seeing the data come in and rate cuts just slowly get pushed back to 2025? Where do you think the dollar goes in that scenario?
When did we start? 107, 108.
Yeah.
And then
that was the first. Yeah, you're right. That's a good way of thinking about it. 107 was when we started to think, okay, Fed might pivot. Oh, it pivoted, right? So that would be a good stopping point for starters.
For a start, and then it can go. It can of course go beyond that, because remember where we had 6.8 at the peak or something. I should say 8 or 9% inflation. 8 to 9 for inflation is 114. So, as the inflation starts ticking up, you raise your targets.
Yeah, and again, I think that it's here's the unlikely devastating scenario is that inflation comes back and rate hikes become a concept again. The market absolutely crashes. Is that likely to happen? Very low probability, but it could. And you have to be aware, this is why you don't get overly optimistic in markets. When everybody thinks we're going to cut rates, if something changes, the risk is massive. So you got to think about that. What are these levels you're drawing for us?
That's when was it 3? Well, it's just what I imagine it to be. Maybe a bit, not that much, but 3% CPI, 5% CPI, 7% CPI, 9% CPI. Those are the level that we're probably going to go back up to 108, 10, also 110, 112, and 114. So
yeah, it could be really interesting. It is also an election year, and so people have their.
If Trump wins, then we can see 120.
Yeah. One thing, I think that I could be wrong about this, but I believe there is some conversation that if Trump wins, he's already said that he would probably take out Jerome Powell, which would be an interesting change in pace in markets. At the same time, I think that, Jerome Powell, I listened to, did you see that 60 Minutes thing that he did that got posted last night, Ivan? Did you see that at all?
No.
I listened to it last night. So they had him on 60 Minutes and they interviewed him, and really interesting interview. And the interview prompt guy, he actually asked him straight up. He said, a lot of people are skeptical that politics play a role in what the Fed does. And Jerome Powell obviously denied that. He's not, even if he is infiltrated by it, he's not going to say that he is. But he was pretty clear in his answer, and one thing to point to is that Trump wanted him to do certain things. He pushed back on it. Congress wants him to do things right now, and he's pushed back on it, right? So he seems to be bipartisan in a way where he doesn't necessarily, he does what financial, he answered really well. He said, this stuff is hard enough with all the different forces and variables that we have to look at, if you try and overlay a political agenda on what we do, it would make our job near impossible. And I thought that was a good answer, because it is a hard job to manage inflation and people's jobs all at the same time. It's, who knows if there is some funny business, but his answer was pretty good. And again, we'll continue to watch that. But during election years, the dollar typically is strong, and so are stock indices. I thought that was kind of an interesting point to think about. So as we continue to play through 2024 here, that's something in the back of our minds that we should consider. Election years are powerful forces on markets.
I just want to clarify what I just mentioned of 3.579% is when if we go back into inflation. But that's not my base case. My base case is that we probably be around 3 or 4 and then probably drop. But because what you have to see and go into is we still haven't walked the walk, even though we can say it's going to be this and this and this. We haven't walked the future. So if people not laid off in masses, people still have a lot of money. Inflation might still go back up, even though it still surprises Powell. But Powell, I don't know, I think it was during COVID, or if not, we can use other central banks as what do you call it? As examples. For example, the British one, when Liz Truss back when she was prime minister in the UK, she did like almost tax cuts to the rich. Inflation was 10%. Everything was like, well, why do you want to do tax cut? And they wanted to cap the energy market of how much electricity and energy costs. And market just crashed to 30-year. And the central bank had to intervene. So he's not out. It's not like Powell is. Politics doesn't intervene. Of course it does. If there is deviance from what you call the normal path, and if it was Biden that didn't put up the transportation. What do you call it? Subsidies back in 2020, also the help packages for transport. If he didn't boost the economy by 3 trillion or whatever they did, then Fed had to do it.
Yeah. I think that I'm really, candidly, I really do not care very much about politics unless it impacts markets. As you guys can probably guess, Ivan and I spend a lot of time on this stuff. So I do care about that one angle. And I do kind of want to see Jerome Powell finish the job. He's done overall, I would argue, a pretty dang good job. Everyone will pick on him for saying, oh, inflation is transitory. But you're talking about a period where there were no historical models to really sample size. COVID, there was no like, hey, here's what we do in this situation. We had massive supply constraints that caused a huge amount of inflation. Think about this, guys. If everybody needs diapers and there's no diapers in the supply chain, guess what happens to the price of diapers? They go up massively. That's inflationary, right? So this was an unprecedented sort of scenario in modern, economic times. And so, all things considered, I think we've navigated it pretty well. And if we continue to see what the Fed has been seeing in their data, we like I said, Ivan, going off your base case, I'm in the same camp. I think that we do see this thing kind of have a relatively soft landing. Is it always going to be perfect? No, but overall, you have to give the man some credit. We were at 9% inflation. We got that down without jobs market going terribly wrong. And you're seeing some layoffs happen now. There's no question that is painful, but part of that you could attribute to the AI stuff that's going on. AI is replacing jobs. That's no question that, you know why the NASDAQ stocks are doing so well? It's because this is sort of a Debbie Downer moment, but it's because a lot of jobs are going to get replaced by computers, and jobs and being lost is causing a huge change in those companies' profitability. It's a little bit kind of a weird thing to celebrate, but Wall Street absolutely loves that. They love replacing people with AI, and whether that's right or wrong is regardless. The numbers that are impacted very positively. So it's a weird thing to think about, but a lot of tech layoffs are happening, and that's kind of a crazy thing to continue to watch roll in.
Yeah. And diapers. That's what you want to have as an example. Okay, cool. Okay.
Well, we could have picked all. I need a lot of diapers during that time. I tell you what, the markets were really crazy. I'm just speaking from personal experience, Ivan.
Oh, okay. So you need diapers. Okay, cool.
Yeah.
I didn't know you have a kid, but
No kid, just me.
okay, cool.
I use the diaper. I'm just kidding. Yeah.
But
You never know. COVID was a crazy time in markets. I would wake up. So they had in our old office, there was a TV, and they would always have like Fox Business or CNBC on the television. And I'd walk in, and there was a period in our old office where the markets were in free fall. And it was like every day I would walk past, and the entire screen was full of red, down 5% time and time again. I mean, during these times, it was like the craziest. It was almost scary to walk past my front office room because the TV would give me a nightmare, because it'd be like, oh, all my stocks are down another 4% today. So I don't miss that experience. And I imagine it was a tough time for a lot of people. A lot of people got, evicted or lost a job, or prices were skyrocketing. It's not been an easy couple of years. I imagine a lot of people can relate. And it's been tough, but we'll see where we go from here.
But back to Powell. For me, as a person, I would say Powell for presidency. Also, if there's one person you want to make, if there's one person in my life at least that would make what I call a never-ending heir of to be the Fed chair, Powell is a very good candidate to be that forever. Like not like a dictator, but just just never ending reign, to be honest.
Yep. I think there's certainly worse people that you could have as a Fed chair. And again, that will be the drama next year this year for us is, again, I don't even really care that much about most topics, as long as it's what'd you say?
Is he up for election again?
Jerome Powell?
Yeah.
Well, he will stay. I actually don't know how that works, to be honest, but I know that he can be removed from his position and by the president, because Donald Trump put him in, and now Donald Trump no longer likes him, because at some point in his presidency he was like, I want to do this, this, and this, and Jerome Powell pushed back on it. And so he doesn't like him anymore. So he has stated that if Trump gets elected, he's going to remove him. So some drama for sure.
Okay, I didn't.
There'll be plenty of that this year.
Yeah, I was thinking of the framework, but then I forgot the political risk that we don't have in monetary policy.
Ballout says Bernanke, and that I would actually say that's probably the best of history in terms of Fed. I think that was the 90s. Was that the 90s? I believe that was the 90s. Fed chair was able to, again, complete a very, very successful soft landing, keeping jobs relatively stable, and the economy roared in the 90s. So I think that's right. But Fed history is fascinating. You guys should definitely check that out. Go look out through history. There was several Fed chairs that did remarkable jobs. There's also some that did really poor and caused massive volatility. Anyways, Ivan, we got to call it here. I want to thank you for coming on the show. First of all, for everybody who's listening, Ivan is one of our coaches inside of the A1 trading community. He does coaching webinars for members. If you're not already in our group and you would like to spend more time on a private basis with Ivan, he does coaching calls with the team. And also, he does one-on-one coaching. So if that's something you're interested in, you can reach out to him on Discord, or you can find him on his YouTube channel right there. Make sure to go subscribe to Ivan FX on YouTube. And Ivan, thank you very much for coming on the show.
Thank you. Thank you very much for having me.
All right. We'll see you next time. And again, guys, definitely hit up Ivan on his channel. Show him some support. We love having him on. He's got great commentary. And, Ivan and I, we don't always agree, but it's a synergy when we do agree. I like when we are kind of seeing the same stuff. It's kind of a confirmation for me. Same thing with Frank, right? When I get these similar starting to see the same trends, starting to see the same setups. That's actually a positive thing for me with these guys, as they have plenty of experience themselves. If you found today's show helpful, let me just ask you to make sure to subscribe, hit that thumbs up button. And also, if you saw the Edge Finder earlier, we're going through the COT data. I mentioned this before. We do offer trials right now on the Edge Finder. If you want 30 days of access of our software, which is our speaking of all this diaper talk that we've spoken about on stream, this right here is our baby, okay? We've raised this thing from infancy to where it is today, and we will give you 30 days access. If you fill out this form, you get more information about it. Just fill out the form. We're going to drop it here in the chat, and you can try out our beloved product here. Click this link. There it is. Take advantage. Just fill out the application to get the trial, and we will go from there. With that said, thank you very much for tuning in. Have a wonderful rest of your day. Trade safe, and I will have a video out summarizing market outlook pretty soon for you guys. Catch you then. See you guys.
Thanks again for watching today's show. Our goal at A1 Trading is to continue to share free value to our audience through daily videos and articles, keeping you up to date with the latest market coverage. If you enjoy our content, make sure to subscribe for more. From all of us at A1 Trading, have a great day, and we'll see you next time.